You're listening to The Intellectual Investor, episode number 97, Downhill Racing Meets Value Investing, written by Vitaliy Katzenelson and read by Elliot. To read this article online, or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Downhill Racing Meets Value Investing. I wrote this article in May. Every time it was destined to be published in the pages of Institutional Investor, it got bumped by another, more timely one I had written. Finally, when a space opened up in September, the market had taken a major dive, and what was supposed to be an evergreen article was suddenly out of touch with reality. Here's the irony. This piece addresses complacency, but its author was complacent too. The market has recouped its summer losses, and this article is relevant again. I am a skier. When someone says this, you assume he or she is good. Well, I thought I was good. I was not Lindsey Vonn, but I had the technique down. I'd be the fastest person going down the mountain, always waiting for my friends at the bottom. Then, at the beginning of last season, I went skiing with my kids at Vail. It had snowed nonstop for a few days. Vail is a very large resort, and the mountain crew could not keep up with the snow. So I found myself skiing on unusually ungroomed slopes in powder more than knee-deep. Suddenly, something changed. I could not ski. I could barely make turns. I was falling multiple times per run. My kids, including my 9-year-old daughter Hannah, were now waiting for me as I dug myself out of pile after pile of snow. My technique, along with my confidence, was gone. The discomfort from constant falling turned into fear. I was ready to go back to the hotel after only 2 hours on the slopes. I was devastated. It was as if I had never skied. So I talked to a ski instructor about this incident. He told me that I am a good skier on groomed slopes because they allow me to go fast without trying hard. Speed covers up a lot of mistakes and lack of skill. Skiing in powder requires different skis, not the skis I had. But more importantly, it slows you down and makes you rely on skills that I thought I had, but didn't. During the past 6 years, the Federal Reserve neatly groomed, manicured, and then finally polished investment slopes for all asset classes by lowering interest rates to unprecedented levels, providing a substantial accelerant that indiscriminately drove valuations of all assets higher. But ubiquitously rising valuations cover up a lot of mistakes and often a lack of skill. Whether you had a rigorous investment process or were throwing darts, over the past 6 years, it hardly mattered. You made money. Bull markets don't last forever, and this one is not an exception. Stock valuations, that is, price to earnings, are just like a pendulum, swinging from one extreme to another. Today, the stocks in the S&P 500 trade at about 50% above their average valuation, if you adjust earnings down for very high corporate margins. Historically, above-average valuations have always been followed by below-average ones, taking away the riches that the previous years provided. In other words, at some point, it is going to snow, and snow hard. Just as I, the great skier, found myself overconfident and unable to deal with the new terrain, investors will find themselves doing faceplants when the stock market turns from bull to bear. But here's the great news. Today, the stock slopes are still finely groomed, with stocks near all-time highs, and we all are given a unique opportunity to make adjustments to our portfolios and investment process. You should start by carefully analyzing each stock position in your portfolio. No drooling over how each of them did for you in the past. Drawing straight lines from the past into the future is very dangerous. Instead, focus on the future. A future in which average stock valuations will likely be lower. Returns for a stock are driven by 3 variables: earnings growth, change in PE, and dividend yield. You should impartially examine each variable to determine if a stock deserves to be in your portfolio. Then make one of 3 decisions: buy more, hold, or sell. Just remember, hold is a decision. If you choose not to sell an overvalued stock, one that has low or negative expected returns in the long run, that is a decision. We must all re-examine and future-proof our investment process. 6 years of rewards and no risk will loosen the process of even the most disciplined investor. Finally, if you are feeling very confident about your investment prowess today, take a moment to relive that gut-wrenching feeling you had the last time the stock market took a 20% dive. This will reset your confidence to the appropriate level and help you avoid the mistakes that come from focusing too much on reward and too little on risk. P.S. I took the kids skiing at Beaver Creek a week ago for the first time this season. My daughter Hannah, who will be 10 in a few weeks, has magically improved over the summer. However, Jonah, who was an amazing skier, has completely lost his form. He grew 5 or 6 inches last spring. He's 14 and pushing 6 feet now. His center of gravity has shifted, and he is still adjusting his technique to his new, oversized body. As a father, I smile when I see Hannah beating Jonah down the slope. Jonah, like any teenager, needs to be humbled. My skiing? The slopes were perfectly groomed. I was awesome. I just hope it doesn't snow. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.